Hello, everyone. Let me see. Perfect. Perfect. You guys should now be able to see me. All right. I am very excited. So this is me, this general investment planning. This is probably the second or third time that I've done this presentation, but it is by far the highest number of registrants we had. I think it was almost 230 people registered. So I am blown away by that. Thank you guys again for attending this. And as we go through it, feel free to reach out with any questions you guys have. I mean, the way that I've currently got the agenda set up is about 30 to 45 minutes of content, 15-ish minutes of Q&A. But if you guys have questions during a slide, don't hesitate to, throw it in the chat, and I'll look at it, I'll read it, and I'll answer it out. So I'm Chad Lively. I'm the lead financial planner of Lively Financial. I created this webinar because I'd seen a lot of, sort of general investment advice that I found either wasn't helpful, wasn't accurate, or just at the very least wasn't very actionable. So my goals were to, show you sort of just the key tools for building wealth, accomplishing financial goals. I wanted to walk you guys through step by step how to start investing. And I wanted to cover some fundamental principles that would, at the very least, if you've already been investing, make you a more knowledgeable investor. So the goal is to walk sort of this fine line between this being kind of a how-to guide with very actionable steps and sort of being finance 101 with some useful information on investing and, some things for you guys to take away. So again, if you've got any questions throughout it, don't hesitate at all. So I've got my second monitor over here. So if you see me looking over, it's because this is where I can actually see where the questions or the chats come through. So before we get into any information, for compliance, I like to give out the disclaimer that everything covered in this webinar is all, for education. It's based on my opinion, my experience in the industry and working with my clients. So it's important to remember, not just whenever you're dealing with my webinars, but just when you're dealing with anyone, that no one can predict the markets. There's no such thing as one size fits all when it comes to financial advice. So think about your situation. Think about what's best for you before applying any advice. And when in doubt, going to a third party like a financial planner is never a bad idea. So, all right, now my compliance department is happy with that out of the way. We can start getting into, first and foremost, why invest? Some of you may have zero experience with investing. Some of you guys may already be putting money into investment accounts or managing your own portfolio. The key thing is that I imagine that all of you who signed up for this webinar because you have some idea of the importance of investing. And that's a massive first step. I know that I constantly see these, very disheartening statistics about how the average person couldn't come up with $2,000 that they needed in 30 days, or how most people live paycheck to paycheck. It is difficult. There are a lot of people out there that are in very tough situations, and just, taking your first step towards investing is definitely something to be proud of. It is worth clapping yourself on the back for. So something that I want to emphasize is, even if, you're on a tight budget, just putting away some money will have some pretty incredible implications for your future goals. Investing is going to allow your money to grow over time. It's going to increase your purchasing power. It's going to be really the only way you're going to be able to combat inflation. And essentially, it's going to allow you that while you're working, you're going to be able to set aside money and let it compound. And through that, you're going to accumulate enough wealth to be able to afford things that you otherwise wouldn't be able to. This is pretty massive. On a lot of people's budgets, they'd never be able to, afford a home, for example, without compound interest and saving up money for 5 to 10 years. So investing is really what's going to allow you to accomplish a lot of your financial goals that you otherwise may not be able to afford. For the younger professionals I work with, starting with investing is typically the toughest part. Giving up that initial portion of your income for things that can be pretty far down the line is not always easy and doesn't always feel good. But I recommend considering one very simple truth. Every milestone in your life, whether that be getting married, having a child, buying a home, buying a car, or just retiring, every single milestone in your life is going to involve money. pretty much bar none. So ultimately, the earlier you start saving and investing, the more you'll be able to take advantage of the power of compound interest, the more you're going to save yourself a lot of stress and difficulty down the line. With that being said, though, I also want to make it very clear that it's never too late to start investing. I've worked with people that are, around 50 years old and maybe haven't had an opportunity to invest a lot of their life, but they still want to retire. It's never too late to start investing, no matter what your age is. Investing is going to help you accomplish your long-term financial goals. So you've heard me mention it quite a bit. Something that I talk about a lot is the power of compounding. It's really the whole reason why you start investing. So to emphasize this, I like to use this very simple example. This is just a graph of the S&P 500. For those of you who aren't, aware of it, the S&P 500 originally was created in 1928. It's the 500 biggest publicly traded companies in the U.S. Usually, whenever you hear people or the news talk about how the market is doing in general, they're typically referring to the S&P 500. So since 1928 up until 2019, the end of this chart, the S&P 500 has averaged nearly 12% return per year. This even takes into account things like 2008 or the dot-com bubble, these pretty big market downturns. Even with those being taken into account, the S&P 500 has still averaged almost 12% per year. That is a pretty great example because it's an easily accessible investment. First and foremost, a lot of people, one of their big barriers to entry in investing is they don't know what should I buy. I get to another slide. Probably the number one question I get is, Chad, what stocks should I be buying? And my answer is you probably shouldn't be buying individual stocks, but buying the entire market is usually a good first step for a newer investor. So for this example, the next slides in this one are really just to show you the power of compounding. But I do want to give, the preface of this that, past returns are no guarantee for future returns. Even though the S&P 500 has averaged that 12% over the last 100 years, it's not guaranteed that you're going to get it this year or anything like that. This is all just a really good example of a very accessible investment and just how powerful compounding is. So keep this in mind as we go on to the next slide. Now, so taking that, nearly 12% annual return, it's actually about 11.82% average that the S&P 500 has had since inception. Keeping that in mind from the last slide, this is how your money would grow if you maxed out your individual retirement account. So as of this year, that's $7,000. So assume that you set aside $7,000 each year. You put it into that, you get that S&P 500 11.82% average return. In 5 years, your portfolio would be worth nearly 50 grand. In 10 years, you'd have more than $100,000. In 20 years, you'd have 500K. And in 25 years, you'd break over $1 million. If you're, say, 35 now, looking to retire in 65, in 30 years, you'd have nearly $2 million. And this shows just how powerful compounding is and why it's never too late to start investing. Naturally, as I said in the prior slide, the S&P 500 return cannot be guaranteed, but it's a good sort of baseline of a very accessible investment and just how powerful compounding is. So keep these things in mind. This should hopefully motivate you, seeing that $7,000, depending on your budget, can be a lot for a lot of people. But maybe you don't max out your IRA. Maybe you just set aside a couple $1,000s per year. The point being is that compounding is going to greatly help you amass money in the long run. Now, hopefully you've gotten motivated to some degree. We've seen the positive effects. How can we actually start investing? So what we're going to cover in this webinar are 5 steps to get started with investing. First, we're going to discuss determining your goals. Then we're going to talk about opening up investment accounts, creating a budget to set money aside for investing, purchasing investments to build your portfolio, and then finally, evaluating your investments as your life and goals change. So 5, pretty, I think, approachable steps to really getting your feet wet with investing. So, as I said, the first step is determining why you're investing. I recommend that you pull out a sheet of paper, you lay out at least one short-term goal, something that you want to have accomplished in the next 2 to 4 years, a medium-term goal, something you want to have accomplished in 5 to 10 years, and at least one long-term goal, something that's 10 plus years down the line. So that's good examples of a short-term goal, something like buying a car. Medium-term goal, something like, maybe getting married, having a child, buying a home. Long-term goals are things like retirement, maybe starting a business, maybe buying rental property. Those are some pretty good examples. And definitely don't be afraid to have more than one goal for each of those time frames. So, but understand which ones are most important. Separate your goals between, being essential and being non-essential. This is what's going to really set the baseline for our risk tolerance. And that's going to be an important part of our investment portfolio later in the presentation. So for example, working with a client, they want to retire in 30 years. They also want their retirement to be with they want to buy a fancy boat to sell the world, a very adventurous retirement. So, in 30 years, we're going to have this retirement. In 30 years, we're also going to want to buy this big boat. Between those two goals, obviously retiring is more essential than buying the boat. The goal is to accomplish both of them, but it's important for the risk tolerance to really determine what's vital and what's less essential. From this point, try to get just some sort, even if it's just kind of a guesstimation, understand how much money you're going to need to accomplish these goals. And that's going to be a pretty huge foundation for starting to invest. Like I said, it doesn't need to be exact. I mean, as I sort of quoted at the start of this, the vast majority of people, have next to no savings. I promise you that just by having some sort of idea of the goals that you have laid out, some semblance of how much it's going to cost you to accomplish, that's going to go a long way towards seeing how much you need to invest and really setting yourself up to accomplish these financial goals. So try to get some sort of price tag associated with the goals, even if it's kind of just your rough guess. So some things to keep in mind once you have a semblance of those goals is that as we delve more into specific investments, based on your goal we're trying to accomplish, your investing style should be different. A good rule of thumb is that if it's a shorter term focus, you're going to want to emphasize preserving capital and prioritizing liquidity. If it is essentially what that means is that if it's a shorter term goal, you're going to want to focus more on keeping the money that you have and making sure it's available when that goal or that opportunity arises. Whereas if it's a long-term goal, you're going to focus on growth and capital appreciation. Something like retirement, you're going to focus a great deal on retiring your income so that it can appreciate for the time that you actually need it for retirement. You're not going to have any hopefully no sudden emergencies that will require you to take money out of your retirement account. So liquidity isn't quite as important. And think back to that S&P 500 graph we looked at. We saw that over the long run, it averaged, like I said, about 11.82% per year, despite there being financial downturns like 2008. So even though, especially the long-term goals, you're going to live through financial downturns, like I said, think back to that graph. It's not the end of the world unless, the S&P 500 really just explodes, which I don't expect would happen in our lifetime. But no one can predict the next downturn. So if your goal is far off, like I said, retirement 30 years down the line, you'll be able to weather those storms. The S&P 500 will return back to that 11.82% as we saw in that graph historically. You're able to weather that downturn. Something to be cognizant of, though, is that if it's a short-term goal, let's say, it's a short-term goal and it's currently 2006, at that time you can't see the future, but the 2008 crash is just 2 years away. If you don't invest in such a way to focus on capital preservation or prioritizing liquidity, then when that short-term goal starts to come to fruition, you're going to be right into that 2008 crash that's going to cause you a lot of issues. So like I said, if it's short-term, keep in mind that you want to focus on preserving capital, prioritizing liquidity. If it's a longer-term goal, you're going to focus on growth and capital appreciation. So lastly, and this one is very easy to forget even though it is so obvious, keep in mind that eventually long-term goals become short-term goals. You start out maybe 30 years from retirement, then you're 15 years, then you're 10 years, then you're 5 years, then you're, next year you're retiring. Your long-term goals are going to become short-term goals. And as that's happening, you should be, updating your portfolio to move away from that growth and capital appreciation to focus more on preserving capital and prioritizing liquidity. These are something that's going to be ongoing changes that you're going to want to update. All right. So now we have our goals determined. We're going to look into opening up some investment accounts. There are a lot out there. Broadly, I've split them into two categories: tax advantaged accounts and taxable accounts. And again, I want to be clear, there are more of both than just the ones I have listed here. It's a pretty much whole world of the amount of accounts there are. But these are some very simple and good starting points for just opening up accounts and starting to invest. So tax advantaged accounts are going to be things like your 401k accounts, 403b accounts, your individual retirement accounts. These accounts give you some type of tax advantage for moving money into them, and we want to take as much advantage of these accounts as we possibly can. The other type of account is taxable accounts. These accounts will enable us to invest money, but it won't come with any inherent tax advantages. So, for example, things like I said, 401ks, 403bs, these are employer-sponsored accounts, meaning they are set up through your employer. They oftentimes have some level of matching. Like a lot of my clients, up to the first 6% of their income that they invest into their 401k is matched by the company. A traditional IRA or a Roth IRA, these are individual retirement accounts set up by you that offer tax-deferred contributions. Or traditional IRAs, they're tax-deferred, meaning that the money you put in today is going to be before taxes. But you'll have to pay taxes when you take the money out later down the line. Roth IRAs are sort of the opposite, in that you put money in after tax dollars, and you avoid paying taxes in the future when you take the money out. So some notable downsides, though, like I said, we want to take as much advantage as we can of tax advantaged accounts. But some notable downsides is that most taxable accounts have a limit to the amount of money you can put into them. On top of that, they usually have taxes and penalties for taking money out of them if you do it prematurely or before a certain age. Meaning that things like a taxable brokerage account is usually better for something like an emergency fund, where you might need money immediately. You might need it long before retirement. A general flow chart I recommend to clients is, first and foremost, try to max out your 401k, or at least reach the maximum match your employer offers. So like I said, for a lot of my clients, that's 6%. At least try to hit that maximum match that your employer offers. After that, max out your individual retirement account. And then if you still have money left over, invest whatever's left into your taxable brokerage account. So, 401k, at least get the match. Max out your individual retirement account, and then anything left over, put that into your taxable brokerage account. There we go. I don't know. Sometimes slides are moving a little slow. All right. Now that we have the accounts opened up and sort of a plan of how to use them, we have to determine how we're going to get the money to actually start investing. So with this, it starts with making a budget. I'll admit some of you may have actually attended it, but I have a much longer webinar on budgeting that goes more in depth than we will here. But just as a pretty, simple starting point, I've laid out a few steps. So start by getting a firm understanding of your income and expenses. And I cannot emphasize this enough. I will have, prospective clients, they'll reach out, they'll want to work together. And whenever I start asking questions like, what's the interest rate on the debt you have? How much in debt are you? Or how much income do you bring in? They, might have a rough guess of how much it is, but seldom do they really know, what the interest rate is on their debt, or really how much they're bringing in per month. And this is really, that's the starting point of your budget. And it's not fun. And these are usually things that at some point in time we knew or we tracked, but, we either just don't like looking at them. Like I know people that get anxious just opening up their bank account, or it's just something that, it kind of stopped being a focus a while ago. But for budgeting, we need to start out by really understanding our income and expenses. So first, you're going to want to figure out exactly how much money you're bringing in each month on average, how much money you're spending each month on average. And then you're going to figure out what you're spending it on. How much your expenses are going to bills, how much are going to utilities, how much of your expenses are going to hobbies and luxury items. Determine what you're spending your money on, how essential that is. And from there, we're going to determine what expenses you will, be comfortable with decreasing, maybe which ones are not comfortable decreasing. And from that point, we should have a pretty solid number of our expenses. From there, subtract those expenses from your income, and you should have whatever's left over should be, your investable amount of remaining money. Most budgeting is getting the unfun initial step of building a budget out of the way. And then it's all about building up consistency. And I built a lot of budgets for clients. Normally they have, some sort of trigger or something that gets them really eager to start budgeting. And then next month, their budget gets blown up by some sort of random emergency, like a car trouble or something like that. If your budget is a priority and it's realistic, that part's important. I've seen people come to me with budgets they built themselves that just flat out were not very realistic. But if it's a priority and it's a realistic budget, more often than not, you should be hitting your budgeting goals. It's not the end of the world if you mess up 1 month or you mess up even 2 months. If it's really a priority and it's realistic, you should be hitting your budgeting goals more often than not. And just doing that is going to set you head and shoulders of where you would have been otherwise in terms of your financial goals down the line. So I go into it, excited with an open mind. Because building a budget, like I said, the hardest part is usually that initial step. All right. So now we've got we've got the goals set aside. We've got the accounts open. We've budgeted to have some money to put into those accounts. Now we can finally start talking about investments. So for most of you, your investment portfolio is probably going to be made up of 4 asset classes. Equities, which these are going to be stocks and ownership in companies. Fixed income, which is mostly going to consist of bonds, where you're effectively lending money to the government or a corporation and you receive interest and payments back from that. Cash and cash equivalents. These are going to be very liquid, low risk, and low return investments. Most commonly, these are used for things like emergency funds or funding shorter term goals. And lastly, you'll have something like real estate take up another portion of your portfolio. So for many, their home is their single biggest purchase that they'll ever make, and it's going to be a large fraction of a lot of people's overall assets. So the goal is to split up our investment portfolio between these investment classes. We want to diversify our holding. Like I said, 4 asset classes. I don't recommend nearly anyone be 100% in equities or 100% in bonds or 100% in real estate. We want to have our portfolio be, like I said, partially equities, partially bonds, partially cash. An easy example, and like I said, your specific situations, your goals are going to really impact this, but just an easy example is that for clients that don't have a complicated financial situation, I'll typically recommend a pretty simple portfolio of either 60 to 90% equities, depending on their age, and the rest of it probably being largely in bonds or cash equivalents. So like I said, maybe, 80% equities, 15% bonds, 5% cash equivalents. So then as they get older, I'll decrease that equity holding and I'll increase their bond holdings. So for example, like I said, a 25-year-old walks into my office. I may have them in 90 or 95% equities and 5 to 10% bonds. As they get older and they begin approaching retirement, like I talked about it a couple of slides ago, we want to start moving away from growth and appreciation to focusing on wealth preservation and liquidity. So as they get older, let's say they're 70 now, I might take that, 90% equity, 10% bond portfolio. Now they're 70, and I'll have that more as like 60% or 70% bonds with 30 to 40% equities. So there's a lot of personal situations and financial goals that can impact this, but that's a pretty, simple and kind of run-of-the-mill standard portfolio. Now, Obviously, I've thrown out the asset classes. You might be thinking, like, Chad, you said I should have, 80% equities. What equities should I actually buy? That is the number one question I probably get is, what stock should I buy? For the vast majority of people, especially newer investors, I recommend not investing in individual stocks. Outside of discounted shares that you might receive from the company you work for most people, I would recommend leaning toward buying, index funds, exchange traded funds, mutual funds. Buying into a fund will get you much more diversification than buying a single stock or a handful of companies. For example, I showed that graph of the S&P 500. VOO, or ticker symbol VOO, is a tax efficient, it's a low cost exchange traded fund that tracks the S&P 500. I'm not necessarily saying that it's appropriate for everyone to buy into, but that's a very easy, simple way for a new investor to buy into an index fund that immediately gives them the diversification of every company in the S&P 500. So buying VOO is like buying a small piece of every company in the S&P 500. So you're getting much more diversification for your investment than if you just bought all Amazon or all Tesla or something. Or, as I touch on a later slide, like all GameStop, because I'm getting a lot of questions about that later. If you do decide you'd like to invest in individual stocks or you want to do your own research, there are two types of investment analysis. The first is fundamental analysis. This is looking at a company's financial statements, really digging into their earnings and speculating whether or not they're going to be a strong investment. So for most people, I usually don't recommend fundamental analysis because it takes a lot of time. It takes a lot of expertise. Even then, usually it won't pay off. And that oftentimes, like I said, active management just gets beaten out over the long run by passive investment. The other method is technical analysis. This type of analysis, this is what you'll see like day traders use. Those guys that have like 9 monitors and stock graphs all over the place. Technical analysis is basically following the historical price of an investment and using that to try and predict its future price changes. It's highly speculative, even more speculative than fundamental analysis. For the vast majority of people, I definitely recommend avoiding technical analysis. So I really just included this slide because in this day and age, you see a lot of investment gurus on YouTube or TikTok, and they will use these styles of analysis to try and convince you that their stock is a good investment. They'll show you a graph of the historical price of some sort of stock, and they'll show you how it's going down or it's going up, so it's a great time to get in. Or they'll show you, the financial statement of a company and say, look at their earnings. It's a great time to get in. I want you guys to be aware of these styles of analysis, but also know that for the vast majority of people, it's not necessary. It's not appropriate. Like I said, both of these are really ways to usually actively invest, and over the long run, passive investments have historically always beaten active investments for the most part. So for most people, I don't recommend buying single stocks. I don't recommend day trading. I recommend building a strong, well-diversified portfolio and holding it for the long run. Very, very Warren Buffett style. But so along with all those things being said, there are some additional fees that come along with investing. As I mentioned in the last slide, I recommend buying into funds, but things like mutual funds, exchange traded funds, they can come with fees that will be charged. So essentially a percentage of your investment in the fund can be taken as a fee. So be aware of the expense ratio. Buying and selling investments can also have transaction costs. Some platforms have moved away from charging a commission on trades, but it's still something to be cognizant of depending on the platform you're trading on. And then what is also particularly important and oftentimes overlooked is that if you already have a financial advisor and they aren't fee only, they may be incentivized to put you in expensive funds or their specific company's investments because they collect a commission or a kickback on the money you invest. So be aware of the expenses that come with that. So it's one of the reasons why I recommend a fee only financial advisor. I am biased because I'm a fee only financial advisor, but to sort of avoid that conflict of interest, I typically recommend, leaning on the side of fee only. Outside of expense ratios and transaction costs, investing can also come with some tax consequences. Like I said in a prior slide, This is especially true if you invest in tax efficient accounts like retirement accounts or 401ks, and you try to prematurely take money out. You may end up with some tax consequences, some fees. So be aware of all of this before you buy or sell an investment. Look into, or have your advisor look into, the costs associated with it. All right, now we've got some idea of the types of accounts we'd like to purchase, or the type of investments we'd like to purchase in our accounts. It's time to really start strategizing for investing our money for the long term. The two options I recommend are, like I said, we're investing for the long term. I highly recommend leaning on the side of passive investing. So we're going to really look at two strategies. It's going to be buy and hold or dollar cost averaging. Most likely, we'll end up implementing a combination of the two, but effectively, buying and holding is moving a large lump sum into the market and holding it for the long term. The benefits of moving a lot of money in as early as possible is that it allows all of that money to benefit from the maximum amount of compounding. So buying large lots can also decrease transaction costs, but the downside is that the money is more vulnerable to market fluctuations, particularly in the short term. So to sort of give you a very simple example, I talked about how for this year it's $7,000 to max out your retirement account. If you had $7,000 on hand, your options are, you can put it all in. Let's say you put it all in January 1st. It would give all of that $7,000 a full 12 months, this entire year to compound. But let's say January 1st just happened to be sort of the bottom of the market or the top of the market. It's going to throw off your investments, especially if that's the top of the market. So it's been going down since. You'd see a lot of short-term volatility. So the trade-off is more short-term volatility, but also more opportunity for your money to compound. The other option is dollar cost averaging. This would be spreading your investment in fixed amounts over a period of time. The upside to this is that the money will be invested at different points in time, so it will reduce the impact of market volatility. But the downside is that the money invested later will not compound as much as the original investment. Basically, what that means is that if you had $7,000, instead of doing it all a lump sum January 1st, you say, I'm going to do about $580 per month for the next 12 months. So you still end up investing $7,000 to max out your IRA for the year, but it would be, in monthly intervals of $580. So the downside is that obviously, the $580 you invested January 1st, that's going to compound much more than all of the, later investments of $580. But you're going to have less short-term volatility. Like I said, with the lump sum, you could have put 7,000 in. That could have been the top of the market. That could have been the bottom of the market. You're going to have a lot more volatility. If you average your money out 580 per month, some of those 580 is going to come in at the top of the market. Some going to be at the bottom. Some going to be somewhere in the middle. You're going to decrease your short-term market volatility. So like I said, it's really whether or not you want to trade off the additional compounding for the, better or not as severe short-term volatility. For most, I recommend a combination of these two, buying and holding for lump sums, such as if you get, you want to make an initial investment, or if you have a pop in income or you get a bonus from work. These are good opportunities to, make a large investment. Then I recommend on the budgeting side, really focusing on dollar cost averaging. Like I said, it's much simpler to break down $7,000 into $580 a month than it is to just come up with $7,000. It's going to make your budgeting a lot easier if you set aside exactly how much money you want to invest each month. So I recommend a combination of both buying and holding and dollar cost averaging. Now, it's for most, the hardest part of investing, the waiting. We have the account set up, we have the money moved in, we've got the investments picked out and purchased, but our goal is still, years away, maybe even decades away. You're going to read articles, you're going to hear news stories about changing market conditions and how the S&P 500 is performing or underperforming. It is very easy to get scared into making a mistake. Like I said, especially when our goal is, 30 years down the line, that's a lot of time to really watch the market and hear a lot of things. And what you'll find is especially whenever you start investing. I talked about figuring out the expense ratio of the investments that you have. As you start doing research on these things, a lot of the marketing that a lot of the ads you encounter are based off your search history. Whenever you start doing research on investing, you're going to get flagged as a potential investor, and that's going to lead to you seeing a lot more advertisements for stocks, a lot more advertisements for bonds. You're going to get ads from, like I said, investment gurus. As you start digging into this and you start, investing, you're going to probably end up interfacing with a lot more news about investing, whether that's by choice or just by, targeted ads. So it's very easy to get scared, like I said, into making a mistake. 2 market cycles that I want you to be aware of is a bull cycle and a bear cycle. These are really the 2 that you probably hear about the most. And they're as simple as a bull market is a period of rising stock prices and positive investor sentiment. A bear market is the opposite. It's a period of falling stock prices and investor pessimism. Most people focus on that, rising stock prices for a bull market, falling stock prices for a bear market. But the most important part is actually the investor sentiment. The market is driven by the investors. So really, if investors are pessimistic or they're optimistic, that's going to be the overall driving force of the market cycles. So I want to make it clear that no one can time the market. The vast majority of people who try to time the market end up with fewer gains than they would have if they just left their money in. And even those who do successfully time the market over the short run eventually lose out in the long run. So understand your investment strategy, understand your time horizon, stay confident that time in the market is going to beat trying to time the market. And understand that, like I said, over the course of 30 years, you're gonna live to see a lot of bull markets, a lot of bear markets. Don't get scared into, messing up your portfolio or selling off your holdings. So outside of the news trying to get at your hard-earned investment income, you're also going to hear about other investments. So it's important to understand the relationship between risk and reward. Typically, higher returns are going to come with higher risks. But higher risks don't always necessarily come with higher returns. This is particularly true with private investments. So understand your risk tolerance. If someone, pitches you out a stock or a cryptocurrency that's, offering 50% returns, keep in mind that there is almost certainly, if it's, even tangentially possible for it to do 50% returns, it's almost certainly has equal or substantially more risk. So be aware of, the things that come with it, and risk and return are a pretty simple relationship. Most people can understand if it's going to have a higher return, it's probably going to have a higher risk as well. So don't pull your money out and put it into a new investment every time you hear about one. Also, understand market volatility. It's going to be inevitable. There will be times that your investments are down, especially when you're dealing with a 30+ year time horizon. Understand volatility and don't get scared off by it. Because while all these things seem very easy to go, yeah, this is great advice, I'm going to follow it, I won't get scared out of selling my investments. What ends up happening is that the stars sort of align. You got a 30-year time horizon possibly before retirement. Like I keep saying, that's a lot of time for you to, see a lot of information, for you to be exposed to a lot of these temptations. What's going to end up happening is that a day is going to come where your portfolio is down just due to short-term volatility, and your friend pitches you this really great hot stock. And you're going to think, my portfolio is down, so what I'm doing must not be working. And my friend says this is a great stock. That's whenever, those 2 or 3 things line up that you're going to decide, I'm going to, blow up my portfolio to buy into this new hot stock. So my point being is that, fend these things off. It can be hard. But if you are, having issues with this, just keep in mind that staying informed, and I'll talk more about this on the next couple of slides, is going to help you with sort of fending off those temptations. So beyond just not blowing up our account over the course of our long-term goals, keep in mind that our portfolios are going to naturally change over time. To some extent, like I said, I tend to recommend passive investing. So a lot more, kind of set it and forget it. But keep in mind there are maintenance that you're going to have to do on your portfolio. it is a living and breathing thing. So you're going to have to make updates to it. Like I said, you're going to want to change it as you get closer to your goals, but you're also going to want to change it as maybe your investments perform differently. For example, I gave that, I was talking about, a 25-year-old that has a portfolio that's maybe 90% equities, 10% bonds. What you'll likely find is that if bonds have performed really well and stocks have performed poorly, your portfolio is then going to naturally go from being, 90% equities, 10% bonds to maybe 80% equity, 20% bonds. Or alternatively, stocks have been doing great and bonds have been underperforming. You might see that your portfolio has gone from being 90% equities to 95% equities and 5% bonds. Because basically what's ended up happening is that you started out 90% equities, 10% bonds, but then as equities did really well, they started going up in value. As bonds did poorly, they started going down in value. Now all of a sudden your portfolio went from being 90-10% to 95-5%. And this can mean that you're taking on more risk than you originally planned or feel comfortable with. So keep in mind that you're going to have these fluctuations in your portfolio. And that doesn't mean you should be actively, constantly trading, constantly monitoring it. For the most part, these things aren't that big of a deal and they'll kind of level themselves out. It's just if you're in a very turbulent market conditions, something like, think back to like 2020 or even some of the crashes like 2008. During times like that, you'll see some massive changes in value between asset classes. So just keep in mind that, you may at the end of that have to realign your portfolio with your goals. So beyond this, a lot of people receive stock options through work. Keep in mind that this is a very consolidated stock position. So whenever you buy into a portfolio, you think that your portfolio is 70% equities, 30% bonds, but then you forget about how you've got a lot of your money tied up into your company stock. If you include that in your portfolio may end up looking more like 90% equities, 10% bonds. So in these equity positions in your company is also very, like I said, very consolidated. Whenever you have a portfolio of one specific stock, particularly if it's the company you work for, be aware of the risk ramifications. For example, and I have seen this happen, if your company has a really rough year, you could get laid off. And at the same time, because your company just had a rough year, your investment portfolio could tank. And that is sort of the worst case scenario, especially because I've seen people that are nearing retirement and all that happens. They're nearing retirement. A lot of their portfolio is in their company. I worked for about 5 years for the United Parcel Services, so for UPS. I saw that a lot with, guys that have been drivers there for decades. They have one rough year and, they're like 65 years old. Maybe they would have considered just going ahead and retiring earlier, except they got, maybe laid off at the exact same time that UPS stock tanked because it had been a really rough year. So whenever you have, you have a lot of eggs in one basket, whenever most of your portfolio is your company, and that's also the company you work for. So with that being said, definitely take advantage of, all the retirement benefits your company offers. I'm not saying don't buy any company stock. Like I said, when I worked at UPS, I think they gave us like a 10% discount on stock. That's a pretty, sizable discount. That's a good investment for your portfolio. Just be aware that you don't want to put all of your money into one basket. So keep these things in mind and how, that company stock plays with your overall portfolio. All right. So we've sort of gotten through a lot of the 5 initial steps that I talked about, setting goals, opening up the accounts, moving money into them, buying the investments, managing and maintaining your portfolio over time. Now I wanted to have, a couple of mistakes to avoid. And they're ones that I've kind of already touched on, but I want to reiterate the 2 most common mistakes I see, especially with newer investors. That's going to be over trading and chasing hot stocks. Especially in today, like I said, with investing gurus on social media, it is very easy to get caught up in the new high trend. Just the other day, GameStop sort of had a huge spike, and I've already got questions about whether or not, clients should buy into GameStop. What's going on with GameStop? Is it another short squeeze opportunity? You're investing for the long term. Short-term fads aren't worth your time getting caught up in. Don't chase hot stocks. Don't overtrade in your account. If you take anything away from this webinar, understand that time in the market beats timing of the market. And that is vital. What you're going to end up doing is, if you're trading actively a lot, even if things seem good, what you're not realizing is that for all the times that you think the market's going to do bad, so you pull it out, you think it's going to do well, so you put it in, all that, one, you might incur quite a bit transaction costs, but also your money's not going to be compounding on the times that it's sitting on the sideline. So you think, oh, this looks great. I got maybe a 10% return on my money because I made this, awesome investment that my friend recommended me. Now that investment's not doing well, I think I'm going to sell it, and I'm just going to, leave my money out on the sidelines for 6 months. Leaving your money on the sideline for 6 months, even though you made a 10% return, your money's not going to compound for all that time that you're waiting for this next strategic allocation. And that's going to end up with, whenever you subtract all that out, mental math wise, your 10% return, when you get rid of the fact that inflation is going to eat into it, you're not going to have your money compounding. That 10% return by the end of the year, if you don't let that money do anything else, is going to look a lot more like a 3% return. That would have been worse than if you just left it in the S&P 500 for the whole year. So keep these things in mind. Like I said, I especially for newer investors, heavily veer towards recommending more passive investments. So if you are really someone that gets anxious about your investment portfolio, or you feel that you're very susceptible to influencers, the best way to make yourself feel comfortable is to stay educated. Like I said, a lot of the things that I've sort of harped on in this webinar, it's not rocket science. It's really not that complicated. It's some very surface level research, and it's pretty apparent why passive investment has historically done better than active investment. Just seeing things like that makes it a lot easier to sort of push away these temptations. So, research a bit, learn a little bit about markets, investing, read books, follow reputable sources. This stuff is my life. I feel free to reach out for some book recommendations. All right, you will probably make my day if we get a good chance to talk about it. I love reading these things, so I'm always happy to give recommendations. Beyond this, if you really struggle with managing your own portfolio, or you need customized advice, just get a financial professional. Like I said, I'm a certified financial planner. I'm more than happy to help anyone on this call. So if you have questions or just want a second pair of eyes to look over your financial situation, please feel free to reach out to me. All right, before we get into the Q&A, the sort of final slide, the conclusion, I kind of just wanted to wrap things up, reiterate some things that you guys have, I've said throughout the PowerPoint, but essentially, the big takeaway I'd like everyone to get is, first and foremost, investing is going to be an invaluable tool for building your wealth. You're going to be able to achieve financial goals that you otherwise would not be able to if you didn't invest. You want to invest with your specific goals in mind. So, don't just take, the advice that someone else gives you, or don't just do what someone else is doing. Your specific goals, your specific time horizon, your specific risk tolerance are all very important for how you should be investing. Diversify, stay disciplined with your investments, monitor your portfolio, make sure that it's, lined up with that time horizon, that risk tolerance that you're wanting it. And like I said, I typically recommend veering on the side of passive investments more than active. All right, so now we are getting into the Q&A session. So please ask away. I'd love to hear what you guys have to say, and thank you all again for making this webinar possible. Like I said, about 230 registrants, by far the highest registrants that we've gotten, and it's blown me away. So again, I'm Chad Lively. I'm the lead financial planner with Lively Financial. Be on the lookout for an email I'm going to send with a link to the recording whenever I publish it to the YouTube channel. And as I said, if you've got any questions or just want a second pair of eyes to look over your plans, feel free to give me a call. Send me an email. And here, let me make it easier to post the Q&A. All right. Now, so it looks like we've got some questions. I also have a few I've gotten before today. Like I said, this is not the first time I've done this webinar. So I've got a couple of questions from prior times that I just felt were really good that I wanted to include. So let's get into answering some questions. So the first one, should I focus on investing or paying off debt? So I love this question because it's very relatable. A lot of my clients, pretty much, a vast majority of the clients that I've even encountered, usually have some level of debt. And the question is always, do I go ahead, do I knock out the debt, or should I start, investing my money? And it can be complicated and simple. It can be complicated in that it ultimately comes down to two factors, which is your expected return on investment with your portfolio, and two, how comfortable you are when it comes to living with debt and the risks associated with it. So if the expected return on investment of your portfolio is higher than the interest rate on your debt, then over the long run, you should have more money by investing and slowly paying off your debt. Something else to keep in mind is that things like your individual retirement account, it has a limit of $7,000 that you can invest per year. So if you spend 1 year focusing on debt and not putting money into your retirement account, that's one fewer years of $7,000 that you can move into that account. There is some opportunity cost there. You can't just say, hey, I'm going to not put money in my IRA, my individual retirement account, and instead pay off debt. The next year I'll put in double the amount for the individual retirement account. Unfortunately, you won't have that option. So like I said, the long term, you should end up with more money if you focus on investing, if you think you can get a higher expected return than the interest rate on your debt. Otherwise, you should focus on paying down the debt. With this being said, though, and something that I feel like is very important to consider, is that holding on to debt does come with risks. And some people find it very uncomfortable or stressful to live with debt. Above all else, your happiness is the most important factor. So if having debt stresses you out, I recommend paying off your debt. I would recommend focusing on that, even if it's not the most financially optimized strategy. What is a good short-term investing option with rates that may be better than a higher yield savings account? Looking to prioritize liquidity. I like this question. So I will warn you that whenever you start looking at, I both want it to be safe and have a high return, it's going to be tough. Like I talked about in a prior slide, there is a very linear relationship with risk and return. They're going to be pretty interconnected, but you can definitely find high yield savings accounts. Beyond that, maybe looking at something like money market accounts might be competitive with it. But whenever especially with how rates are going, I know that I saw an account through my custodian the other day. It's basically a high yield savings account, but it was proclaiming that it could get about a 5% return. And that's historically, 5% return is very high for a high yield savings account. If you're going to look to try to beat that, you'd be, while still maintaining, things like liquidity, you'd be looking to invest in some, very traded stocks. Well, what I kind of mean by that is, investments that are frequently traded on the market. So it is very quick and easy to convert them to cash. For example, like I talked about VOO, it's an index fund. So you could buy that and sell out of it pretty quickly. You could probably do that in, T+2, which is like 3 days time. So that would be relatively liquid. It would be something that, you would be taking on more risk, but it would lead to you getting a better yield than a high yield savings account. All right, how do I know how much I can invest? So like I touched on, ideally you live with some sort of budget in mind, but a good general flow chart is cover your necessities. So, food, bills, rent, focus on building an emergency fund, then max out your 401ks like 403b. And after that, start looking at investing in, individual retirement accounts or setting aside some money for a health savings account. Really, without, digging into your financial situation, I couldn't really tell you like specifically how much you should set aside for saving. I know a lot of people throw out the sort of rule of thumb of 15% of your income. Depending on where you are in your life, 15% can either be too much or too little. It's not a bad target, but I would really recommend digging into your own expenses and figuring out your own budget. What are some good investments in your opinion? So what is a good investment? As sort of answer to another question, what is a good investment is very dependent on your specific situation. But I recommend to new or less experienced investors look toward index funds. Being able to buy low expense ratio funds that offer you a lot of diversification, a lot of liquidity, so you can come and go from them easily. And there are some that, like I said, I mentioned the S&P 500. There are some that track the S&P 500, so they'll tie your returns to that of the market without you having to do as much work on your end. It's for new investors. I definitely would look towards things like index funds. What should I consider when choosing an investment professional to help me? I like this question because you're basically asking me to do a little plug. But the first thing I would look into is, are there any conflicts of interest? Namely, is the advisor fee only or are they fee based? So I touched on it in a prior slide, but if the advisor is fee based, it means that they could be collecting a commission on the investments they recommend to you. This incentivizes them to recommend investments that may not be optimal for you, so that they can make more money, essentially. I highly recommend getting a fee-only financial planner. The only rate they charge is a percentage of the money they manage for you, or a flat dollar fee. For example, I'm fee-only, meaning that I get paid a small percentage based on the money I manage for my clients. And I don't accept any commission. I don't get any kickback. I don't receive any compensation from third parties. All right, this means that I am always able to have my client's best interests at heart, and I'm able to be 100% transparent. So, in short, when you're considering an investment professional, look for them to be fiduciary and fee only. So that's a good place to start. Like I said, I'm a CFP. I'm a certified financial planner. CFPs typically have that standard of having to be fiduciary and fee only. Can I strike a balance between investing for retirement and other financial goals, such as buying a home or paying off debt? Yes, you absolutely can. Like I said, I recommend that you have, multiple short-term goals, multiple medium-term goals, multiple long-term goals. A good financial plan should take into account all of your financial goals. Naturally, the more goals and restrictions you have, the more complicated a financial plan will end up being. But a well thought out plan will include all of your financial goals, and your investment portfolio will reflect it. So, all right, let me see. Are we getting any more questions? Well, I tell you what, we are right about at the top of the hour. So again, thank you guys for coming. I really appreciate it. I appreciate the support. Like I said, 230 registrants is crazy. I never would have thought that we would have got that much reach. But thank you guys for coming. Thank you guys for enabling me to do this. And again, if you need anything at all, don't hesitate to reach out, shoot me an email, give me a phone call. You can book a meeting with me through our website. So I've been Chad Lively, and thank you guys again for coming. Have a great day.